Hello, and thank you for joining us at xm.com for this Forex Preview video. We'll be having a look at UK data out this week and the outlook for the pound. I'm Cristina Marujos, and joining me today is investment analyst Cristina Bartenidu. Cristina, we have jobs numbers out of the UK on Tuesday, while GDP growth figures will follow on Wednesday, and the data will be published just a few days after the Bank of England said that the economy is recovering at a faster pace than expected, but at the same time sent a cautious message about the labor market. Now, what should we expect from these numbers, and how could the figures affect the market sentiment after the Bank of England statements?
Hi, Christina. Well, looking first at GDP numbers, the UK economy is expected to report its second negative consecutive quarter and therefore officially enter a recession this week. We expect to see an annual 22.5% contraction in the second quarter, which will be around the central bank's estimates for that period and the largest decline the UK experienced in a century. However, markets may not react much on the quarterly numbers, but pay full attention to the June's readings instead, which is forecast to show a record expansion of 8% from May, because everyone is more interested to know how conditions evolved after reopening plans took effect, and June's readings may provide a better view on that and therefore have a greater impact on the pound, especially after the Bank of England said that the heat from the coronavirus was shallower than initially thought. However, I think that the impact could be short-lived for now, because the future of the virus is very unpredictable and a full reopening may not take place unless we get a vaccine. So what could keep a footing under the pound is a continuous improvement in the data in the coming months, or at least a better data performance than the data in other countries, and for that to happen we may need additional stimulus to support businesses and the labor market. And at this point we shouldn't forget that we are talking about the UK, which is also facing the Brexit uncertainty, so the overall risk is still skewed to the downside this year and probably the next one, and the government must ensure that the economy is not heading to a cliff before it decides on the Brexit trade deal. Now, about the jobs numbers on Tuesday, the unemployment rate is expected to rise to the highest in 2 years, and I think that could bring some nervous to the markets and add pressure to the pound, but probably any weakness could be limited as the central bank has already informed market that the rate could rise up to 7.5% this year. So again, here the job releases in the coming months may play a key role, showing whether the current stimulus is working or not, and therefore whether it's helping the labor market and consumption to strengthen.
So, Christina, if the risk is overall tilted to the downside, why has the central bank decided to keep policy unchanged last week?
Well, the infection cases in the UK haven't really risen steeply so far, so we can't say that COVID-19 is making a second round in the UK. Of course, that forced Boris Johnson to wisely delay its reopening plans and re-examine the conditions in 2 weeks, which may cut growth. But we still don't have a red warning so far, neither the negative data. And given that the government has expanded its own recovery fund last month, that gave the chance to policymakers to adopt a wait-and-see approach and see how things will develop now that the government is gradually scaling back its job rotation scheme and companies must start paying some pension and other costs. However, the bank didn't exclude the case of more stimulus in the near future and showed a willingness to provide more support if the data take the wrong way, saying that the negative rates remain in the toolbox, although there is not an urgent need to apply them immediately. So perhaps more quantitative easing may be the next choice this year if growth stalls.
Finally, turning to the pound now, it failed to close this week higher against the US dollar because of Friday's losses. Do you think it could resume its rally this week?
Well, it could do so if the data surprise to the upside, and the bigger the surprise, the better for the pound. However, other factors may intervene and disturb this story. The Congress in the U.S. is still debating the extension of the recovery fund, which expired at the end of July, and if we get some positive news that the U.S. Congress is close to make a deal, then that could benefit the dollar and therefore hurt the pound. We saw the pound losing ground on Friday because of a stronger NFP report, so developments in the U.S. May affect the pound. Moreover, the U.S. currency, it's the world's reserve currency, and it could gain if tensions with China intensify, so the battle with the pound could be challenging for the pound. Technically, I think that cable should close above 1.29 to come under renewed selling, so as long as it holds above that level, it may attempt to break its recent highs.
Christina, thank you so much for joining me today, and thank you for watching this Forex Preview on UK data and the pound here at xm.com.